Hi everyone. Short presentation today on the US economic data and how it looks like the data are considerably weaker than are currently being reported. And this comes down to revisions. It's not a conspiracy. It's just something that happens, and it's something that tends to happen at turning points in the economic cycle. First thing to say is that data do get revised, and they can get revised very meaningfully on timescales of months, years, even more after the original release. So this is something that has come out relatively recently from the UK Office of National Statistics. And the dark blue line is performance of UK GDP, and the other lines are the performance of some of the other major developed markets. And as you can see, since the pandemic, or since Brexit, you could say the UK has meaningfully underperformed these other countries, or at least is at the back of the pack. And the narrative is that this relates to the impact of Brexit. Now, the ONS came out with a series of revisions recently to their GDP data, and the UK is now the dotted line, or the dashed line instead. And of course, this invalidates that theory. The UK is now in the middle of the range. Now, of course, it doesn't mean that Brexit hasn't had a negative impact. Of course, everything over this time scale is confused by COVID. And of course, this is still a relatively short time scale. Also, of course, we can see revisions to all these other countries as well, which may well be upwards, and the UK may well end up at the back of the pack. But the message to take from this is that the data change, and they can change pretty meaningfully. And this goes for short-term data as well. So these are job creation numbers from the US employment report. The last 7 months, we've seen that revised down. And it's seen by some people that this is indicative of a turn in the economic cycle and how the US economic performance is turning down. And this is something that happens at times when the US economic performance is turning down. Again, jobs are still being created. These are changes numbers rather than job creation numbers, but they're being created significantly more slowly than initially reported. So here's the nub of the issue. US Congressional Budget Office came up with a report recently on the performance of the 2023 budget, and it's significantly worse than it was in 2022. And of course, people are talking about how this is massively impacting the US Treasury market and is causing the bear steepening that's taking place. Now, let's ignore all that and go back to the story. What we're seeing is expenditures increasing a bit faster than expected, but still pretty fast, about 10% year on year. And revenues are down. And that's extremely interesting because, of course, the data for the last 9 months has shown pretty healthy GDP growth in the US. And certainly nominal growth should be in the order of 5 or 6%. And that should see revenues going up. And they're not. Revenues are going down. And this is important because, GDP data and a lot of other data prints are, academic constructs which are used to measure the economic activity of the country, whereas this is actually real numbers. These are tax collections. These are things that can be counted. They're tangible. And they're significantly underperforming what they were expected to be. And they're significantly underperforming them when they really shouldn't. The forecast used by the CBO a year ago included a recession for 2023. Not a big recession, but certainly not the 2% growth numbers that we have been seeing over that period of time. So the question is why? And my conjecture here is that the US economy is actually performing pretty poorly, and maybe that GDP is not contracting, but it's certainly a lot closer to flat than the numbers are saying, and that's clearly a big downside, would be a big downside surprise if we were to find this out. And I'm pretty comfortable believing these data over the GDP data and some of the other reported data, although to be fair, most of the reported data are pretty flat anyway. Has this happened before? The answer is yes. I mean, you go back to the 2008 recession, take the data as they were then, which is the blue line. This is an index of GDP over the period from the end of 2006 onwards to how we view the GDP data now, which is the orange line. And as you can see, there's a big divergence which starts in 2008. And if we accumulate the GDP prints as they are reported in the US as annualized numbers, this is a difference of almost 7% of GDP. I mean, of course, it's less than that when we actually look at the numbers correctly, but it's big and it's real, and it happens at the time where the cycle starts to change, where the growth that we saw in 2007 peters out and we stumble into recession in 2008. So this, for me, is a big alarm bell. The US economy is performing a lot worse than we think right now, and that should have implications for asset markets. It should mean that fixed income is going to perform a lot better over the course of the next months and year, I should say. And equity markets, yeah, I mean, the Federal Reserve will become more dovish when we have this realization, and that should be good in the short term. But the view on growth is pretty negative for stock market in the longer run. Thanks very much.